most investors watching defense stocks right now are looking at the wrong companies. Everyone is rushing into names that have already doubled and tripled, while a smaller group of companies, the ones supplying the technology, connectivity, and power systems the entire modern defense industry runs on, are still sitting under $20. One of them is a literal penny stock right now, but analysts are projecting over 240% upside on that name alone. If you close this video in the next 30 seconds, you miss the exact window that investors who got into similar names last summer wish they had caught earlier. We saved the most important detail about the third company for the end, and it changes how you think about this entire sector. Stay with us. If you are new here, this is Market Authority. We do not just read you a list of tickers. We explain the actual business, the financial reality, the valuation logic, and the risks. Everything you need to make your own informed decision. If that is the kind of investing content you have been looking for, subscribe right now and hit the bell. It takes 2 seconds and it keeps you ahead of the crowd. Before we name the first stock, let us talk about mindset for 60 seconds. Because if you go into early stage companies with the wrong approach, even a great pick will hurt you. The biggest mistake people make with under $20 stocks is treating them like lottery tickets. They buy on a headline, panic when the stock drops 10%, and sell right before the real move happens. What actually works is understanding the difference between price and value. The price is what you pay today. The value is what the business is worth based on its growth trajectory, its contracts, and its free cash flow direction. When price is significantly below value, that gap is your margin of safety, and that is where real upside lies. For early stage companies, that gap can be enormous if you're patient enough to let the business grow into it. With that framework in mind, let us get into the first company. The U.S. military is expanding its use of drones faster than most people realize. Surveillance drones, combat drones, logistics drones, unmanned systems are being deployed across every branch right now. And when most investors think about profiting from this trend, they look for the company that builds the finished drone. But that is the wrong place to look. The smarter play is the company supplying the components that go inside every drone, regardless of who makes the airframe. The motors, cameras, flight controllers, and accessories. Because whoever wins the drone race, those component suppliers win with them. There is a company that has built its entire model around being exactly that kind of essential supplier. They are not competing to build the best drone. They are making sure every drone manufacturer needs to come to them for critical parts. They already have a contract with the 101st Airborne Division of the U.S. Army. That is not a pilot program or a letter of intent. It is a live, active supply relationship. And once a supplier gets into the U.S. military's approved vendor ecosystem, the switching costs to replace them are extremely high. The military does not change suppliers casually. This company is called Unusual Machines, ticker symbol UMAC, trading on the NYSE American Exchange. The stock has only been public since 2024, so there is limited history. But the data we do have is telling. The stock is up over 41% year to date. Only 4 analysts cover it, but their consensus price target is $20 per share, approximately 35% upside from where the stock trades around $15. Needham and Company issued that same $20 target most recently. On the financials, free cash flow is currently negative. This company is still in investment mode. Revenue last quarter came in just over $2 million. Small, but the trajectory is the story. Analysts project $3.5 million next quarter, climbing to $8.5 million by the same quarter in 2026, a 4 times increase in 12 months. Institutional buying is already outpacing selling, and this is a fully American company with domestic manufacturing, already NDAA compliant and eligible for U.S. defense contracts. Drop a comment right now. Had you heard of Unusual Machines before this video? We read every comment here at Market Authority. The second company is completely different, but equally essential. It is about the signal. The real-time data link that lets an operator pilot a drone or remotely controlled vehicle with full visual awareness and zero lag. The most sophisticated drone in the world becomes useless the moment connectivity degrades. The military understands this and is actively investing in connectivity infrastructure as a core part of their unmanned system strategy. This company offers 4G and 5G mobile broadband solutions designed specifically for military and remote operations that require full real-time control of unmanned vehicles and aircraft. They are not pitching a future capability. They are already providing this technology in active defense operations. The company is called Inigo. And what separates it fundamentally from the first company is where it sits on the profitability curve. As of earnings reported in February of this year, Inigo is profitable. They delivered positive adjusted earnings per share of 12 cents. 1 year earlier, they were at negative 4 cents. That swing from cash negative to cash positive means the business no longer needs to dilute shareholders just to keep operating. Free cash flow is moving in the right direction, and that changes the risk profile significantly. Annual revenue runs between $45 and $48 million, stable and consistent. The market cap is only around $187 million, meaning you're buying this profitable business at roughly 4 times annual revenue. The analyst consensus price target is $16.50, representing over 40% upside from today's price. TD Cowen raised their target to $15 in January, signaling continued institutional confidence. The risk is real. Small caps are volatile. But you are buying a profitable company with active defense exposure at roughly 4 times annual revenue, a valuation that has not yet priced in rising government spending in this sector. Of the 3 names today, this one carries the best margin of safety. If this video is delivering value, share it with one person who talks to you about investing. That single share helps Market Authority grow, and it costs you nothing. Now we get to the third company, and I want to be upfront before we go here. This is speculative. It is a penny stock. It missed revenue estimates last quarter. It is not profitable, and will not be for several quarters. If any of that is an automatic disqualifier for you, revisit the first 2 names. But if you understand how speculative positions work, small sizing, long time horizon, eyes wide open, this is one of the most compelling turnaround stories in the defense-adjacent space right now. Every drone, every eVTOL aircraft, every military robot runs on a battery. Specifically, a lightweight, high-energy density battery that can handle real operational conditions without failing. Battery technology is genuinely the bottleneck holding back the entire unmanned systems industry right now. The platforms exist. The demand exists. The company that solves this problem at scale does not just win a contract. It becomes infrastructure. This company develops AI-enhanced lithium metal and lithium-ion rechargeable battery technologies for urban air mobility, drones, and robotics, the exact platforms the U.S. military is investing in most aggressively, and they are making a strategic pivot right now worth paying attention to. They are shifting manufacturing from Southeast Asia to the United States to become NDAA compliant, moving from being locked out of U.S. defense contracts to being one of a very small number of domestic compliant battery suppliers for the military. That is a massive change in addressable market. The government is already serious about this space. Archer Aviation and Joby Aviation have both secured U.S. government contracts for eVTOL platforms. If those aircraft need better batteries, and they do, a compliant domestic supplier becomes essential, not optional. Now the honest numbers. The stock is trading around $1.20, a true penny stock. It is down over 30% in the last month. The most recent earnings showed revenue of $4.5 million against expectations of $6.9 million. That miss is significant. Free cash flow is negative and cash burn is increasing. These are real risks that need to be weighed seriously. But look at where analysts see this going. Revenue projections for 4 quarters from now sit at $13.8 million, 3 times what the company just delivered. And the analyst price target is $4 per share, representing over 240% upside from current levels. Small allocation. Long time horizon. If the NDAA pivot executes and the revenue ramp plays out, the return potential is unlike anything else on this list. Tell us in the comments. Do you think battery technology is the single biggest bottleneck in the drone and eVTOL space right now? We want to hear from you. Let us bring it all together. 3 companies, 3 different business models, 3 different risk profiles, all connected to the same story: the rapid expansion of U.S. defense spending on drones, unmanned systems, connectivity, and the power technology behind all of it. Unusual Machines, ticker UMAC, is the drone component supplier with a live U.S. Army contract, domestic manufacturing, negative free cash flow but a 4 times revenue ramp projected, and an analyst consensus target of $20 against a current price around $15. Inigo is the defense connectivity company, profitable, improving free cash flow, annual revenue between 45 and 48 million, market cap of only 187 million, and over 40% upside to analyst consensus. Best margin of safety on this list. The third company is the battery technology play, penny stock, negative free cash flow. Revenue miss last quarter, but an NDAA compliance pivot underway, a 3 times revenue ramp projected over the next year, and over 240% analyst upside. Highest risk, highest potential. Size it accordingly. The investors who build real wealth are not the ones chasing the hottest ticker every week. They understand what they are buying, pay a price below fair value, let free cash flow and revenue trajectory guide their conviction, and have the patience to let a thesis develop over months and years, not days. That is the process we teach here at Market Authority. If today gave you one new idea, one new framework, or one name worth researching, share this video. One person, 5 seconds. It is the most meaningful thing you can do to support this channel. Nothing in this video is financial advice. All content is strictly for educational and informational purposes. Every investment carries risk, including the potential loss of principal. Always do your own research and consult a licensed financial professional before investing. Market Authority is here to help you think more clearly. The decisions are always yours. Invest wisely, invest patiently, and we will see you in the next one.